Hi everybody and welcome to this evening's webinar. We are delighted to be joined by David Keating, and we have a bonus speaker this evening, Shane Cullen, who's going to assist David with this evening's presentation. So we've been really keen to bring you something in relation to mortgages, life assurance and pensions. We know that this is an area that people living with MS do want further clarity around, and we're delighted to be able to bring these speakers on this evening to chat to you about those things. So David started his career in Dublin City Council, and he went on then to do an MBA program in Trinity College. He spent 20 years in senior management at Board Namona and SAP. And then in 2009, apologies, he entered the world of financial services. He is qualified and certified financial planner and holds an MSc in financial planning. And Shane is a mobile mortgage manager with Bank of Ireland who has 10 years experience in financial services and specialised in mortgage lending for the past 6 years, and is qualified as a financial advisor. So thank you both for joining us this evening. Throughout the presentation, you're welcome to send in any questions that you might have through the Q&A function or the chat function, and we'll try to get to as many as we can. So we're going to split the webinar in two. The first section is going to be about mortgages and life assurance. The second section will be about pensions, and we'll do a Q&A session for both of those. At the end of the webinar, you might also be asked to complete a survey, and I would ask you to complete that if you can. And with that, I'm going to hand you over to David.
Okay, thanks, Aoife, and good evening, everybody. As Aoife said, there's kind of two pieces what we'd like to talk about. First of all, I'm going to look at mortgages and life assurance, and then talk about pensions. To some extent, they're all related, to the extent that they're all in some way or other about money. But there are other relationships that I'll highlight as well. So what I'd like to do is, first of all, as I say, to talk in general about life assurance and mortgages, and then to talk about some of the specific issues relating to these. So I've got some slides here, if I can get them up on the screen. So some practical issues in terms of mortgages. Well, some of the parameters around which you're going to consider getting, or you'll be considered in terms of getting a mortgage. First of all, in terms of the amounts you can borrow, the general limit is 3.5 times the combined income of two people, or 3.5 times if it's an individual application, then it's 3.5 times the income of the individual. You would need to demonstrate repayment capacity, and that typically is done through providing bank statements. Typically, in terms of stress testing, you're looking at about 50%, a maximum of 50% of your net income is the amount that a bank would be considering that is the amount that you shouldn't be committing any more than that to paying a mortgage. And in terms of stress testing, what that means is the bank will assess how a 2% increase in interest rates would likely to be impact on you. So in terms of putting the rule over all of that, that's done by a financial underwriter. Now, obviously they're working for the bank, but they really are working for the bank, but they also have your situation in mind as well. Nobody wants to get into a situation whereby you're going to have difficulty either now or in the future in terms of meeting your payments. In terms of the variables in the equation, when you're looking at borrowing money, I mean, in terms of the limits of what you borrow, I've referred to them above. Then there is the issue of whether you go fixed or variable, or indeed whether you break the mortgage and have an element of both. And the final thing, it's a thing I think from experience myself that is often overlooked, is the issue of term. How long are you going to borrow the money over? Again, from my experience there, if you possibly can, I would advise people to reduce the term initially, or at some stage in the future, if they can do that. The reason I'm saying that is, ultimately the best way to save money on the cost for mortgage over the lifetime of the mortgage is to compress the term. So this slide here gives an idea of a loan of 300,000 at an interest rate of 3.7%. How much are you going to pay over the term of the loan? So as you can see, if you take a 30-year term, then the repayment is going to be 150 euros per month, the total repayment of the lifetime of the mortgage is going to be 485,000. So if you initially were to say, well, look, maybe we could push things a little bit harder, reduce the term down to 25 years, then the repayment is 1,500 euros per month. The total repayment of the mortgage then is 450,000. It's 1.5 times the sum borrowed. Now, I've rounded these figures, but the issue here is that there's two impacts there. One is that you're saving 35,000 euros over the term of the mortgage. The other one is that you are going to have the mortgage paid 5 years earlier than you otherwise had. And when you get to my age, and I was 60 a few weeks back, to have a mortgage paid 5 years earlier gives you a huge amount of peace of mind, particularly if it's family home. The knowledge of knowing that you own the roof over your head. It also has an impact on pension and retirement planning, which I'll talk about later. In terms then of getting the mortgage, in terms of getting your ducks in a row, sometimes people maybe start by going out and trying to find the house, and then say, oh, now we better get this mortgage sorted. Certainly, you should be giving thought to the mortgage, when you're starting a house search. And the key things that you need to be doing in terms of getting your ducks in a row is, first of all, demonstrating repayment capacity. Through showing a savings record, and through compiling, a list of your incomes and your expenditure. In that regard, it is probably best to have one bank account, through which most of your transactions go, and ideally have that account with the institution that you're considering taking the mortgage with. The rent that you're paying, and a lot of people are paying fairly high rents at the moment, that will be taken into account in assessing affordability and repayment capacity. And in terms of the record, how far back financial underwriters will look, typically that's 6 months or a longer period if you are self-employed. In terms of deposit, generally for first-time buyers, you will require 10% of the purchase price. For second-time buyers, it's 20%, and things can vary with regard to apartment buying, something that Shane maybe will comment on in a moment or two. So that is kind of the picture in terms of the mortgage. The other side of the coin, or the other aspect to this, is that you're going to invariably will require life assurance in order to get the loan. And life assurance is also required for other reasons, but the two reasons I've indicated them here on this slide. So life assurance is a means of protecting against the financial impact of untimely death. So, and there's two main reasons to have it. One is to ensure that a significant debt, typically a mortgage, is paid in the event that you went to heaven in the morning. And the second one is to replace the income that would disappear again in the event of untimely death. And that's particularly relevant if you have dependents, people who are dependent on your income. So we talked about financial underwriting, whereby somebody puts the rule over your financial well-being in order to assess your suitability for a mortgage. In terms of getting life assurance, you undergo medical underwriting. So this is the process whereby a life assurance company would assess the risk that they're taking on. And there's various parameters then that they will look at in terms of that. Age is one. So, a healthy 25-year-old is going to find it more easy to get cover, than a person who is older. Certain other factors then will have a bearing either on the cost of the cover or on your likelihood of getting cover. One of them, smoking, for example, generally that will not preclude you from getting cover, but it will probably increase your premiums by 50 to 100%. It's a good reason. If you're a smoker and you want an additional incentive to give it up, there certainly is a saving there. With regard to that, if you have smoked in the past, your smoking history is forgotten about after you are off cigarettes for 12 months. So once you're non-smoking for 12 months, then you're considered a non-smoker. The other common issue that would cause a loading or cause underwriters pause for breath is high BMI, if you're carrying significant additional weight. Now you need to be in the obese category for that to become a significant issue. There are lots of medical conditions that will cause, that will create questions to be asked, at least from an underwriting perspective. MS condition is one of those, but there are many others. Diabetes, heart issues, arthritis. There's a whole list of medical conditions, that are going to cause the underwriters to ask additional questions before they will offer cover. In terms of going through the underwriting process, there are 4 potential outcomes: cover at ordinary rates, cover at an additional cost, a postpone, or a decline. Now, what I would say for people living with MS, they are unlikely to get cover at ordinary rates. However, they are likely to get cover at an additional cost. Postpone or decline is the result that we don't really want. COVID is causing the number of postponements to increase somewhat. Not hugely, but somewhat. If people are borderline and if there isn't a definitive view at the moment, which there's not, on certain medical conditions and how COVID might or might not impact on those, people are being postponed. It's less likely to be an impact on an MS case than it might be with some others. Again, diabetes is one of the ones where it will have an impact. Having said all of that, they might sound like impediments. Life cover, life insurance companies want to offer you life cover. That's why they're in business, so they will do their best to do it. And when we talk about underwriting, there's an underwriting engine, and some part of it is automated. But at the starting point and at the finishing point of every underwriting decision is a human being, and really, they are concerned and wish to do their best to get cover for people, to the extent that they can. Specifically in terms of people with the MS condition, as I said earlier, I spoke to our senior underwriter yesterday, and his view is that most people, with MS can be offered life cover at an extra premium. It's not always the case, but more often than not, that is the case. What would determine whether cover is offered or the additional cost would be the parameters that I've spoken about there, whether it's benign or relapsing, when your symptoms were first diagnosed, whether you have symptoms at present or not, your mobility, whether you're able to work or not, and whether there are other additional complications. And the more serious type of symptoms that you're experiencing, the more the extra premium is. And hopefully, occasionally, people may tip into the bracket whereby where cover cannot be offered. Underwriters can give an indicative decision if I go to them with a summary of what your current condition is. So you don't necessarily have to go through in order to get cover, you have to go through the process. But I can get an indication if we go to the underwriters with a summary of your condition. I don't have to reveal who you are at the time. That's only done at the time that you propose for cover. So in terms of, in terms of the actual process, the process in terms of proposing for cover is relatively quickly. You need to meet with a financial advisor such as myself or a broker. They would need to complete an application form, and all of this can be done online now during COVID. That needs to be submitted to the underwriting department. They will then write to your GP for a medical report. The questions they will ask, to some extent, will depend on the initial questionnaire that you've completed with myself. Specialist reports may also be required. Now, that is probably, in terms of the timescale, that is probably the thing that is going to cause the greatest delay in the process. Getting back medical information sometimes can be slow, sometimes can be a bit more expeditious. To some extent, it depends on your GP or consultant. They are paid by the life insurance company to provide the reports, so they have an incentive to get them back, if I can put them that way. Plus, if you have a good relationship with their GP, presumably they want you, to have every chance to get the cover as well. Once the information is in and with the underwriters, the decision can happen fairly quickly. They may go back to your doctor or consultant to get clarification on 1 or 2 points, but once it's in, either they will make the decision, and if they're not entirely sure, or they're unsure, then they will go to our CMO, our Chief Medical Officer. But the CMO is available 2 or 3 days a week, and there's a number of CMOs that we would use, and ultimately they may make the determination. So that's how the process works. It can take 4 to 6 weeks. So, you know, if there's one point that I would make is that really you should consider, given that you know that you're going to have to go through, you know, the process of medical underwriting, given that you know doctors' reports are going to be required, you know, you should start this process early. I mean, maybe if you're considering purchasing a property now, maybe rather than doing it in the sequence of find the house, find the mortgage, find the life cover, maybe you should be considering doing it in the opposite direction, at least getting an indication before you start the search, you know, as to whether you're going to be offered cover or not. Armed with that information, then you can go to a lender and say, well, look, you know, maybe I'm borderline, or I think I'm confident of getting life cover, although I haven't proposed for it. And then you can get mortgage approval and then maybe start the search for a property. But certainly, key thing is to start early. In terms of costs, broadly, now these are very, very rough numbers, but I'm sure you might be interested to say, well, how is it likely to cost me to get life cover? What I'm assuming here is that 2 people are proposing for cover. I'm saying age should be 30. Sum assured and is 30,000. It's joint life. They're non-smokers. So a rough estimate, if it is sum assured of 300,000, that's the amount being borrowed for 30-year term. It's in the region of 60 to 70 euros. However, that is a very broad guide. If the term is shorter, then the premium will be less. Okay. So to summarize maybe on this piece, if you think you're going to need cover, well then, you know, start early, make a call and describe your symptoms and get some indication as to whether you're going to get cover or not. It's not going to cost you anything to have a conversation with me in that regard, or indeed somebody else. They should be able to go to an underwriter and find out information for you. Then proceed to the formal application. That is the starting point of the underwriting process. They can be done online. Medical reports would be required. So as I say, start early. In terms of the, you know, in terms of things that arise, maybe some of the showstoppers in general that I've found is one of the questions that will be asked during the underwriting is, are you awaiting an appointment with a specialist, or are you awaiting a test or investigation? If you answer that yes to that question, then you will not be, you won't be offered terms. This MS or whatever the condition is, you know, or even if you're in perfectly good health. I had an example of a client before Christmas, a teacher, he was fit as a fiddle. When I posed that question to him, he said, well, I'm waiting on a colonoscopy. So that stopped the show there and then. So he had to wait through January until he got the colonoscopy. Fortunately, that was clear, but the underwriters couldn't make a decision until they had the result of that. So that's one thing. If you've got tests, scans, or investigations, make sure you have them and expedite them before you propose for cover. You'll be asked about your own medical history, your own family history, but you know, alcohol consumption, height, weight. But you know, it's a standard form, and as I say, one way or the other, a report will be required from your doctor. Finally, you know, if you are declined or postponed, you know what happens. Generally speaking, as I say, it is a condition of the loan that you do get that you have life cover in place, but that's not always the case. In some instances, it can be waived. Lenders in Ireland will require 2 decline letters from 2 different companies before they would then consider you on a case-by-case basis, you know, to proceed without having the life cover in place. The chances are enhanced if one person can be covered, particularly if they're the higher earner. And different life companies, you know, operate under different underwriting rules. Now, that being said, if you are declined by one life company, prospects of getting cover with another are relatively slim. So that's a quick snapshot, Shane. I don't know whether you want to add anything to what I've said there.
Yeah, listen, I think you've touched on most of the important points regarding the mortgage side of things there, Dave. Like the main area that we'd see applicants kind of falling down and applications not being approved is around the repayment capacity side of things. So basically you want to make your chances as strong as possible. So to make things as clean as possible for an underwriter when they're assessing your case. So listen, ideally you'll have a current account and one main savings account that your main mortgage savings are going into each month. If you send in your application and you've 10 to 15 accounts with transactions going everywhere, an underwriter's going to have a bad day when he's assessing your case, which you don't want to happen. So it's to try and package it as best as you can for an underwriter when he's assessing your case. Then you touched on loan to values there, David. So like I said, so the minimum deposit for first-time buyer is 10%, for movers 20%, and you mentioned one bed apartment. So it's slightly different with one bed apartments because they're seen as a slightly bigger risk for the bank. So generally, even if you're first time buyer, you'd still have to put in 20% of the deposit for a one bed apartment. And if it's outside of Dublin or outside of main city, it could be up to 30%. Like the main piece of advice that I'd give for anybody going for a mortgage is, as you said, to meet somebody early on in the process. Like it happens far too often that I'll meet with somebody that'll pick their dream home and they haven't done any of the taken any of the steps that they need to for the previous 6 months to make sure that their application's approved. So what we can do, if you meet me early in the process, is we'll sit down. If you're not ready to apply now, we'll put a plan in place over the next 3 to 6 months to make sure when you do submit your application that it's seamless and it's approved straight away. In terms of you guys are living with MS, like if you do have your life cover declined, I have experienced cases where we can get it waived, like if you different factors are taken into account by underwriting. Like if you have death and service benefit in your current employment, if it's a joint application and the other party has been shown repayment capacity for the mortgage on their own, it's a much stronger case as well. So there's different aspects, which is that they're all looked at on a case by case basis. But it's not always the end of the world if you are declined. So yeah, as far as the mortgage side of things, then Dave, listen, as I said, I think you've covered most of the aspects there, and I'm happy to answer any questions any of the guys have here on it anyway.
Okay, thanks, Shane. Any questions, Aoife?
We have lots of questions in. So some of them were actually emailed in advance of the session, and then we have some questions that have come in live as well. So I might just go to a couple of the ones that have come in live first. So one of them, somebody is wondering if, in terms of the deposit, if one person in a couple is a first-time buyer and the other person has previously bought and sold a home, as a couple, can they still avail of first-time buyer status in terms of the deposit amount that they would need?
They wouldn't be able to, unfortunately, if one of the other parties has had a mortgage on a property previously, they both go down to second-time buyers for any subsequent joint applications. If it's the case that the property was previously bought with cash and there was no mortgage lending on it, then they'd still keep their first-time buyer status. Now, if it's a case that they're put down as second-time buyers, there's a certain amount of exceptions we could give out to the standard deposit rules anyway for second-time buyers, so we could still potentially bring it up to 90%, and they'd only have to put in a 10% deposit. So we've only got a limited number of exceptions we can give out each year, though, so they're all looked at again on a case-by-case basis.
Okay. Somebody is wondering how they can contact you. I think you're going to provide contact details at the end of the webinar. Is that the case?
Yeah, I have the both Shane and my contact details will be on a slide at the end of the presentation.
Great, thank you. So, how long does it normally take for underwriters to look into medical aspects, and are people living with MS or indeed other conditions likely to experience longer wait times for this?
Well, the answer to your second piece is yes. About 60% of applications for life assurance will go through without the requirement to have any additional information obtained from a doctor or a GP. So the answer is yes, it will take longer for somebody with MS or many other conditions, as I said, to obtain cover. The length of time, the key determinant of the length of time is that which is required to get medical information from a GP or a consultant. My experience is that some GPs are excellent. You know, we would send out a request for information, we might have it in 2 or 3 days. Others, there've been situations where I've waited for weeks or even months for information. But I think maybe people with the MS condition are probably likely to have a closer relationship with the doctor because they're probably more likely, you know, to see them. So therefore, you know, a call to your doctor, you know, is often the most efficient way. You know, New Ireland will ring the doctor every week. You know, we're not allowed to ring them every day, but we can ring them from time to time. But you know, what prompts the doctor to provide the information will be if the line rings. You know, but once the information is in, I think, as I said earlier, the underwriters are very quick to make a decision.
Okay, thank you. Do banks take land ownership into account for your deposit?
They do, yeah. So for a self-build application, if the site's in your name, and say for example the site's valued at 50,000, you're looking to do a build of say 300,000, we take the actual value as being the value of the site plus the value of the build, so essentially 350,000. So your normal deposit on a purchase of 350,000 would be 35,000, but the site's valued at 50, so we take that into account. So we can essentially lend you the full 300,000 for the total build.
And there's a question in here from a lady who says that she has MS and that her mother has a chronic underlying health issue. And what kind of impact would that have on getting life cover?
It may or may not have an impact. Depends on the individual circumstances. Certain conditions that are hereditary. First of all, I'd say that in terms of the underwriting process, you will be asked about your family history. So you'll be typically asked, there will be a list of conditions, and you'll be asked, have your family had any of the following? You know, heart attack, cancers, whole range of conditions. That may, if there's a hereditary component to those, that will impact on the likelihood or otherwise of you getting cover. But it really is on a case-by-case basis. But yes, it will have some impact depending on the condition. Just with regard to family history as well, I mean, if you had genetic test to see whether you've got a gene that you're carrying a gene that is hereditary, you are not obliged to reveal that in the course of an underwriting decision. If you are adopted and you don't know, or for whatever reason you don't know what your family history is, well then the answers to the questions with regard to family history is I don't know. You know, I don't know is the answer to a lot of the questions in the underwriting process.
And can you get
But you know, specifically in terms of that lady, you know, I mean, if she wants to give me a call, you know, I can ask an underwriter to see what the likelihood or what the likely scenario is.
Great, thank you. Can you get additional life cover for serious illness if you already have MS?
Generally speaking, no. New Ireland are not in a position to offer life cover or income protection to people with the MS condition, unfortunately.
Okay. And there's somebody else here who is asking, they want to know, first of all, if a diagnosis of MS will hinder their mortgage application, which I think you have covered, so we might skip on to the next part of that. So they're in employment and are automatically enrolled into an employer's group life assurance plan. They were never asked for a medical history or any details. And do they need to inform them regarding MS or continue as they are? I think David might be frozen there. With that, what I might do, Shane, if you can still hear me, is maybe go back to some of the other questions in relation
to life cover.
So are there any additional considerations for cover if a mortgage is for an individual as opposed to a couple?
Sorry, any additional considerations for?
Yeah, so if somebody is going for a mortgage as a sole applicant as opposed to being joint applicants, is there further considerations there for them?
Yeah, again, is this on a case if they're unable to obtain life cover? I presume it is. So, like, again, you'd have to get 2 decline letters, and we'd have to go to our underwriting. If they could confirm to us that they had some additional, possibly death and service cover with their employer, we may be able to look at doing something. But if it's a sole application and life cover is declined, it is quite rare that we'd be able to waive the actual life cover condition on it. It's generally for joint applications where there's a support in the background there.
And some people are just asking here, is it compulsory that people disclose that they have MS when applying for something like this? So it's obviously like they're legally bound to disclose that, are they?
Yes, they will be asked. Can you hear me, Fia?
We can now, David.
Yep.
Yes.
Okay, I've moved here. Yes, I mean it is a question that's asked in the on the application form. So you are required to reveal the answers to any of the questions that you're asked. You, by the same token, you're not obliged to answer. You're not obliged to divulge more information if it's not asked in the underwriting form. But MS is asked, so yes, you are required to reveal that.
And is there a maximum age limit by which banks won't give a mortgage when an applicant is over a certain age?
Well, the max age that we'll do a mortgage up to is age 70. It just, as you get on and the term becomes shorter, it's harder to get a mortgage at that stage because the repayments do become much higher if you're doing a mortgage over 10 years, let's say 20 years. So if you're looking for a mortgage to the bank at age 60, the amount of income that you'd have left over to live on each month, it may not meet our requirements because your monthly mortgage repayment would be so high. But we can still look at it if that person has asked the question. If they're over a certain age, if they want to contact me directly, I'll have a look at their income and what kind of disposable income they have, and then we can see what kind of term we could do for it. But up to age 70 would be the maximum term that we'd look at.
Thank you. So we have another question from somebody who was diagnosed with MS in the last 2 years, and they have mortgage protection for the last 15 years. They haven't actually informed their insurer of this and are wondering what impact that this might have on them. So could you maybe discuss that a little?
Yeah, they don't need to tell. They don't need to say anything to their mortgage provider or to their life insurance company. I mean, if they were underwritten at the time 2 years ago, before they had the diagnosis, it's on the basis of the information that is declared at that time is the basis on which the underwriting decision is made. So they've nothing to be concerned about. They don't need to go to their life insurance provider. It may be an issue if they want to get additional cover or they want to increase cover. Say for example, if you have cover of a certain sum and you want to move house, you want to get a bigger mortgage. Well, whenever you want, if you want to increase your cover or if you want to extend the term of the cover, generally speaking, you have to be underwritten again, unless you have what's called a conversion option. So a conversion option enables you to extend the term of the cover without presenting medical evidence. So the key thing for that person would be to look at their policy, and they should get a policy statement every year and see, is the word medical free conversion or free cover mentioned somewhere on the policy. That means that even if they want to extend the term of the cover, then they can do so. Certain policies also would have the facility to increase the cover by certain amounts without presenting medical evidence. So again, if that person wants to dig out the policy details and give me a call, I could guide them with regard to that.
Thank you.
The other thing, Eva, and I think when I broke down, I think somebody was talking about cover through work.
Yes.
You know, I know it can be a concern for people with MS if they're a declined life cover. I know we're talking a lot about mortgages, and you know, that's maybe when it hurts most, if I can put it that way. But you know, people. The other reason I refer to, you know, if people is somebody who's dependent on your income, you know, what happens then? You know, if you want to propose for life cover and you're declined, you know, again, that is a difficult decision or adjudication to get. However, you know, you do have to maybe go through the rather morbid exercise of saying, well, okay, what are the consequences of untimely death? And there may be other compensations that might kick in. For example, you know, you may have death and service cover. What that means is that some employers have all of their employees covered for a certain sum, you know, a fixed sum. I worked in a company where, you know, everybody had life cover of 100,000. Irrespective of their health. It's just blanket cover on everybody who works in the company. Others might have cover more than that. It could be 4 times salary. So you might have death and service cover. Now that cannot be used to cover a mortgage, but it can, you know, offer some level of cover or comfort that that cover is there in the event that, you know, in the event of untimely death. The other thing is that, you know, we're all entitled to the widow or the widower's pension. Okay, again, it's more of a talk for a Friday evening, but you know, that is, you know, that's €800 per month. If you have dependent children, it's increased by €30 per child. So that is some that's also, you know, some financial compensation. We can't replace the person, but you know, there's some money will come through there. It's possible that that there may be, if somebody has a pension or a member of a pension plan, you know, and I'm going to come on to talk about that in a moment, but, you know, the pension, if they're paying into a fund and they have a pension fund, that is paid out on death as well, to, you know, to a partner or to whomever you nominate, if it's a trust-based scheme, a company-based scheme. So, you know, it's a morbid exercise, but even in terms of assessing somebody's need for life cover, you know, the process, you have to go through that process to say, well, what is the net loss in the event, you know, of income in the event of an untimely death? And sometimes, you know, if you have mortgage protection cover in place already, you know, well, your mortgage is cleared. So sometimes the financial consequences, the purely financial ones, may not be as severe as you might otherwise think.
Thank you. I just think in the interest of time now, it might be a good idea to move along to the next section, and we can do a Q&A after the pensions presentation. We might also include a few more of the mortgage questions because there are quite a few afterwards, if that's okay. So David, I think if you'd like to move on to that section, that'd be great. Thank you.
Okay, well, I go on to the screen.
Yes, you can share your screen.
Again, yeah.
Yeah.
Okay, so in terms of pension, sorry, this thing isn't.
So I think
just bear with me. It's not working here at the moment.
You might be able to change to your next slide. You might need to share your screen again from your PowerPoint.
Okay. Sorry, just bear with me.
Sorry.
Let's see if we can go again. Okay, so in terms of, you know, what is a pension? So in simple terms, you know, there's different types of pensions, but at its kernel, it's a tax efficient way of saving for retirement. And in terms of tax efficiency, the reason why it's tax efficient is there are basically 3 reasons. One is that if you decide to put money into a pension fund or a pension pot, you get tax relief on the contributions. What that means is that, let's say you're on a salary of 40,000 and you don't make any pension contributions, you will be taxed on the entirety of the 40,000. Now, if you're single or if you're married couple both earning that type of money, then you're taxed at 40%. However, if you decided to say, well, look, let's just put €2,000 per year into a pension, you're only taxed on 38,000. So the €2,000 would go into a pension pot and it wouldn't be taxed. Whereas if you were to say, well, I want to save the 10,000 in a bank or a building society, you would, in order to get your hands on it, you'd have to pay tax. So if you're at the 40% tax rate, €800 of that would go. So that's the first main benefit of a pension. The second is that the growth in pension funds, assuming you get growth, is tax-free. So there's no deposit interest retention tax. Now, I know interest rates are on the floor at the moment, so there's no interest and therefore no tax. But if interest rates, rise, you are charged dirt tax on those. Or if you were to make it into another type of investment, typically 40% of the gain that you would achieve would be taxed, whereas there's no tax on the growth in a pension pot. And the final piece in terms of tax is that invariably you will get some of your pension pot tax-free in retirement. Typically it's 25%. So they're the main, the tax benefits of saving through a pension. Now, I'm aware that some people with MS may not be in employment and therefore not paying tax. In that situation, for the time that they're not working, it really doesn't make a huge amount of sense from a tax point of view to be contributing to a pension. They would be better just saving through a conventional savings plan through the bank, the post office, or through the national state savings. In terms of the different types of pensions then, I mean, the big divide, as I call it, are between what's called defined benefit pensions and defined contribution pensions. So defined benefit is where the employer effectively promises you a pension, typically a lump sum and typically a pension when you reach retirement age. So that's most commonly, you find that in civil and the public service. It was quite common in larger companies as well, but because of the cost and the obligation, of providing for people whilst they're working and then during their retirement, most big companies now are withdrawing from their defined benefit pension schemes. So that's why most pension schemes now are what's called defined contribution. So they typically work whereby you and the employer will make contributions to a plan, and these are invested to build a pension fund. And at retirement, you hope, or we hope, that the fund is sufficient to provide for retirement. So the key thing there is that the risk with regards to the return and what you were likely to end up by way of a pension, lies with you or between yourself and the employer. And where there's investment risk, there is uncertainty. But to some extent that can be managed or moderated, but certainly the uncertainty can be eliminated.
Sorry, David, could I just interject there? Your screen actually didn't share. I'm wondering, would you like me to put it up from my side? You could just let me know which slide you'd like me to put up.
Sure. Sorry, Eva.
Not to worry.
Yeah, well, maybe you should from your side, and then I can follow it from here. Okay.
Yeah, absolutely. So if you just let me know which slide you'd like to start with, or I can share from here. Sorry, 1 second now, and you can tell me then to skip on now. So I think if everybody's able to see that now. David, can you see your slides now?
Yeah, I can. If you just keep going on to the blue ones are the is where the pension. Yep. So you just go on to the next one, and then the next one, please, and then the next one. Yep.
Okay.
So, and can you just go back one, Aoife, please? Thank you. So, I mean, maybe some common questions that are asked about pensions. How much should I invest? There's different ways of answering that. If you're looking at, first of all, you could target a certain level of a certain level of pension that you would like to have. So, the first bullet point there says, well, if you had €200, so let's say you managed to save 200,000 euros, how much pension would that buy? And probably to people's surprise, that would buy about 8,000 euros of pension per annum from age 65. So if you had 200,000 euros in your fund, you went to a life insurance company and said, no, I want to buy a pension with that, 8,000 euros per year, guaranteed for the rest of your life is what you'd get. Now people look at that and say that doesn't seem like very much. The reason that doesn't seem like very much is because interest rates are very low at the moment and annuity rates are very low at the moment. There's a connection between the two. 10 years ago, your 200,000 would have bought you about 16,000 euros worth of pension. So you would have got an 8% annuity rate. Today, it's very low, it's about 4. And therefore a lot of people don't want that option. They don't elect that option. They can use the 200,000 in another way. They can take a quarter of that as a lump sum, and they can invest 150,000 and then draw that down. Second option, the second answer to the question, or coming at it from another way, is how much should I invest? You say, well, I want to target to have a certain amount of money at retirement, whenever that is. So, you know, the table below gives you an idea there of how much you might need to invest in order to achieve 250,000. And of course, that depends on your age. If you start at age 30, then you would need to invest in the order of, you know, 450 euros per month to achieve a fund of 250,000. The assumed growth rate here is 3% per annum. So the total invested is 178. And you can see if you leave it until later, obviously, you've got to invest more each month in order to achieve the target fund of 250,000. So the key question, or the key point there, is start young if you possibly can. Next, Aoife, please. Two other ways of approaching the question of how much should I invest. Sorry for the typo there at the top. One is to say, well, you know, you can't invest the maximum I'm allowed to invest. So there's limits on how much money you can put into a pension, and they're determined by your age. So between age 30 and 40, the maximum amount you could put into your salary is 20%. You know, as you get older, you know, you can put a third, over age 60, you can put in 40%. Now, I'm sure people are saying, come on, David, you know, real world here, you know, we can't really, most people can't afford that level. But do bear in mind that you're going to get tax relief on it. So the 20%, you know, of salary, if you take the 40% tax relief into account, is only 12% of salary. Still quite a bit. Some people can do it. If you can, great. If you can't, well, then maybe a smaller amount. You know, and the fourth answer to the question is the one that I've put at the bottom there, is, you know, most people, they put in what they can afford. So can we move on to the next slide, Aoife? So next question that I'm, you know, often asked is, could I lose everything? You know, I've heard of people who've lost all their money in a pension scheme. You know, my answer to that is to say that it is most unlikely that you're going to lose all of your money, but it is very likely that you will have investment gains, that you will actually have more money at the end, you know, at retirement than you've invested in your pension fund. I started my pension plan back when I was in Bordemona. I wasn't allowed to join their pension scheme because I was working on contract. I started back in 1990. I contributed for 20 years. I've got double in my fund today than the money that I invested. Now, the next slide is going to show some of the journey that my fund and most people's fund have gone through. This typically is, you know, a pension managed fund, a fund that a lot of people would be invested in. If you're in a company pension scheme, you know, and you're, you know, in your 30s or in your 40s, you're probably invested in a fund very similar to this. Now, this fund would, you know, we talk about pension funds, they're generally invested predominantly in equities, stocks and shares. So you have a sliver of Ryanair and Google and Apple and Facebook and maybe some of the banks and pharmaceutical companies, food companies, whatever. Typically, you'd have a shareholding in about 500 to 1,000 different equities. That would typically represent about 3/4 of your fund. The balance would be represented or would be accounted for by bonds and a small amount by cash. There might be some property in your fund as well. And different funds have different weightings to those. But this gives an idea of what that fund has performed over the last 15 years. So when you look over, you know, on the left-hand side, you can see the axis there, you know, is going from 0, 50, 100, 150%. And you can see during the period there, you know, around 2008, this was the financial crisis. So you can see that fund fell, you know, over 50% in value during that period of time. It then grew relatively consistently for a number of years, and then around 2015 and 2016, it went through a bit of a wobble, if I can put it that way, and that was around the time of the US election. Not the most recent one, the one part of this, but the one in which Donald Trump got elected. And then we moved on to more recent times in 2020. And again, you can see what happened there during last year. Now, this happened between February and March of last year. Again, fund lost about 50% of its value. Over a very, very short period of time, it was the shortest fall in the history of equity markets, within the last 100 years. Well, what has happened over the last 12 months? The fund has recovered again. So whilst I can say that, you won't lose money from time to time in a pension, this graph, over a 15-year period does say, yeah, there are going to be periods during which your fund will decline. But the overall trajectory of your fund is, in a very positive direction. Now, the other point when we're looking at that is if you were approaching retirement, in the last 12 or 24 months, and the COVID thing happened, it would be a very severe blow to you if you were in this fund. So it's very important as you approach retirement, that you look at the fund. When I say approach retirement, I'm talking about 10 years away from it. That you understand the fund that you're invested in, understand the risk profile of the fund, and make sure that the fund is appropriate to your stage of life and when it is you're planning to draw down benefits. So, at retirement or coming to retirement, you shouldn't be in this fund. You should be in one that has a lower risk rating. So typically, this on a scale of 1 to 7, this fund has a rating of 5. But as you approach retirement, you should be moving down that risk spectrum down 5, 4, down to 3 or a 2 rated fund. You don't eliminate risk, but you reduce it significantly. We'll go to the next one, Aoife. Yeah. So the question is, the next question is, when can I draw down my money? Is it age 50? Is it age 60? Is it when I get the old age pension, which today is age 66? Is it later than that? Is it age 70 or 75? And the answer to that is on the next slide. And the answer is, well, in fact, it could be any and all of the above, depending on the type of pension arrangement that you have and on your circumstances. So, for example, if you're aged 50 and you had been a member of a company pension scheme, but you have left that company, you could draw down your benefits now, anytime from age 50. If it is a personal pension, now typically a personal pension would be somebody who's on contract, like I was when I was with Board of Owner, or somebody who's self-employed and a sole trader. The earliest date by which they could start drawing money from their pension is age 60. If you're in a company pension scheme and the retirement date on the scheme is 65 and you're working till retirement, you have to wait until you retire to draw down your money. With regard to the first two, age, you don't actually have to stop working to draw down your pension. That's I suppose the key point that I wanted to bring out there. As long as you've left service with a company at age 50, you could be self-employed, you could have money in a pension fund, and for some reason or other, one reason or other, you might want to draw money from a pension. So long as you're age 60, all you have to do is to be age 60. You don't have to give up working. In terms of later dates, then 66 is the qualification age for the state pension. Some people would say, well, I'll wait until then and take all my pensions together. But the qualification date for the state pension has no bearing whatsoever on the date at which you decide to take any other pensions that you have. You also don't have to take your pensions by state qualification age or qualification date for the old age pension by age 66. You can defer to age 70 for a company plan, or if it's a personal pension, you have to take your benefits by age 75. If you don't take your benefits, or if you don't start drawing money out of your pension, and you don't have to take it all, but if you don't start drawing money out of a personal pension by age 75, you will be crucified for tax. So, and I know people who are that age, and I know that there are people out there who have personal pensions and they don't even know this. Some people don't even know that they actually have pensions, which is a pity, particularly if they've left employment, many, many years ago. And, I spend some of my time trying to track down people who have pensions. But if I can't find them and they're not trying to find me or trying to find New Ireland or wherever the administrator is, unfortunately their money is there and it will just wilt. So next, Aoife, please. So, I mean, the kind of the summary of what I say is that more than likely, most people now, because of the way in which careers are built, are going to have more than one pension over the course of their career. And as you can see, they can be drawn down at different times. Now, there's a great advantage in that because that opens up possibilities. For example, going back to the issue of mortgages. Say for example you are self-employed, and you build a pension fund of, let's say, 200,000. It's a significant sum, but it can be done. And let's say, well, look, my plan is that I'm going to use the 50,000 from which is going to be paid tax-free at age 60 to pay off my mortgage, because my target is to be debt-free at age 60. Another opportunity would be maybe at age 50. You might say, right, I've worked in a company, I've got a fund of 40,000 in the company. Maybe at age 50, I'm planning to draw down a quarter of that, which would give me 10,000, maybe to pay a college fee. Maybe to say, right, I said I was going to promise myself a big holiday at age 50, and I'm going to use the 40,000, or sorry, use the 10,000 from that to to have a good time. Life is for living, money is for spending, at a certain level. The other thing about staggering drawdowns, and this particularly with in a situation whereby a couple or indeed an individual has a number of different pension pots, it can open the prospect of early retirement. I would spend quite a lot of my work dealing with people who are approaching retirement, and if they have a number of different pension pots, they could say, well, look, maybe age 62 or age 63 is possible. And they could say, well, I know we're going to get a lump sum, so that's going to cover some of the living expenses for the first couple of years. And maybe we could accelerate the drawdown of the balance to cover another 2 or 3 years, and then reduce the drawdown of the pension to give us some additional income then when we get the state pension. So it's important to do, a little bit of planning, to the extent that you can, even when you're relatively remote from retirement. Because what you don't want to do is to end up really pushing yourself to build significant pension funding and to say, well, we're deferring everything until old age pension age, and then you get the old age pension, and if you're a couple, that's 13,000 each, that's 26,000, and then you put more income on top of that, and suddenly you end up paying more tax in retirement than you might otherwise have done if you retired early. It's important to bear in mind that people think maybe when you retire that you move into a different world from the point of view of tax. In reality, you don't. Your retirement income is taxed in the same way as the income that you had whilst you were earning. There are very few exceptions. You get some extra tax credits when you're over age 65. A married couple are allowed to earn 36,000 tax-free in retirement. Single person is 18,000. Certain marginal reliefs, if you tip over those numbers, there's a slightly more benign calculation done in terms of the income that you, or the tax that you're going to pay. Next, we're nearly there, Aoife. There's a few more slides that I just cover off before we take more questions. There's just two final ones in terms of getting value for money. And I'm approaching this in two ways. It's good to think of money, and I've kind of dealt with the issue in terms of getting money on the way in. Talked about the tax relief around that, but it's important, particularly if you're your couple, two people working together, living together, and they're planning together. If one of them is in the 20% tax bracket and the other is in the 40% tax bracket, it makes most sense for the person in the 40% tax bracket to do the pension funding, because they're going to get a better kicker on the tax relief. A second thing is to say, in certain company pension schemes, for example, the employer might make a matching contribution, or they might make a contribution. That is to say, if the individual says, I'd like to join the pension scheme, I'm going to contribute 200 euros a month. And the employer, the rules of the scheme might say, well, the employer will also contribute 100 or a percentage. So, investigate that if you're looking at it jointly and say, okay, who'll get a matching employer contribution if it exists. And then the other thing to look at is looking at efficiency in terms of the way out of the pension scheme. And that relates to the fact of who is going to get most of the money, or who is likely to get more tax-free in retirement. Now this relates particularly to public sector AVCs. I have an interesting case at the moment, and it's not the first I dealt with, whereby a teacher who's age 61 has just retired from her job. She had, in addition to the pension scheme, she had AVCs. These are additional contributions that she made. She built a fund of 120,000 euros. Her husband works in a private company. Because she got a big lump sum from the teacher's pension scheme, from her 120,000 euros, she was only allowed to draw down 10,000 euros tax-free. The other 110,000 is there for her to buy an annuity or to put into a fund that she can draw down in addition to her teacher's pension, but they collectively are going to pay tax on this money. If that 110,000 had been invested in her husband's pension scheme rather than hers, he would be allowed to draw down 25% of that as a tax-free lump sum. So particularly, I think, with, in a situation where you've got people, public sector employees, where their lump sum is a condition of their service and their salary. If they have long service, and are going to have full service, the chances are that they're not going to get very little or none of their money out tax-free at the end. If they've got a partner who's working in private sector and can fund through a DC arrangement, going back to one of the first slides, it is probably more advantageous for the person with the DC arrangement to do the pension funding. So, this is where, getting advice, if that teacher and the man I was talking about, if different advice had been given to them, 15 and 20 years ago, when the teacher was building her fund, and said, well, look, maybe it's Tom, your husband, who should be doing this, but they'd be in a slightly better position at the moment. It's still not a bad idea that she has that money, but it would have been more efficient and better for them if they'd done it differently. The second and the final slide, on getting value for money, is in terms of the charges, associated with pensions, which is the next slide, Eve, the last one. And it looks at fees and charges. There's two main fees or charges that are associated with pensions. The first is an allocation rate, and the second is a fund charge. So an allocation rate is the money that you put into a pension plan. Typically, some of that doesn't actually make its way into the plan. It is taken as a charge by the administrator to cover their costs and expenses, and to make some profit. Now, typically, the allocation rate, it's called an allocation rate, and 95% looks good, but that means 5% of your money doesn't make it into the plan. If you're a sole individual with PRSA, that may be the allocation rate that you're going to be offered and that you will get. If you're in a very large pension scheme, 100% allocation might happen. If you're in a very large group pension scheme with a very large company, typically all of the money is invested in the plan. Then for others, it is somewhere in between. My point here is that can be negotiable, and you should ask if you're starting a pension, or indeed you're in one, ask, what is the allocation rate of my premiums? And just, there may be something you can do about it, there may not be something that you can do about it. But if you're starting a pension, certainly you should have an eye to that. The other charge is a fund charge. Typically, so this is a fund, an amount that's levied, that's taken from your pension fund every year. So typically that's 0.75 to 1.5. So if you have a pension fund of 10,000 euros, and it's a 1% fund charge every year, that's 100 euros. If your pension fund is 100,000 euros, 1% is 1,000 euros. So as your pension fund grows, the fund charge becomes a significantly higher charge on your fund than the allocation rate. So, for example, if you're putting 5,000 euros a year into a pension fund and you're getting a 95% allocation rate, well then 5% of the 5,000 is 250 euros. Whereas if your fund is 100,000 and you're getting 1% fund charge, your fund charge is 1,000 euros. My point is that whilst the allocation rate looks as though it's the one that does the most damage, if I can put it that way, over the long term, it's the fund charge is the one that if you can negotiate that down, it's where you're going to get the best value over the long term. I suppose that's the key point that I'd make with regard to that. I think that kind of, I mean, the pensions are relatively complicated. And yet at the same time, basically, as I say, they're an efficient way of saving for retirement. Again, maybe with regard to life cover, and mortgage, again, it's an issue of trying to get some advice and try and make the best decisions you possibly can, given your circumstance at a point in time. If your circumstances change, well, then have a chat with somebody, get some advice, and maybe you need to change something. I think the final slide then has our contact details, Eva, and that's all the talking that I'll do for the time being, anyway. Thanks very much to everybody for listening, and the questions coming in seem to indicate that there's a level of interest in the subject. I mean, as I say, myself and Shane are quite happy, to take calls. There's no consideration or no obligation, on you, if you want to have a quick chat, with either of us. We certainly will help in whatever way we can, and that might lead you in another direction, or it might lead you to doing some business with ourselves. I'm a tied agent for New Ireland. I'm self-employed. Shane works for Bank of Ireland. He's a mortgage advisor there. That's it. Thank you.
Great. Thank you. Thank you, David and Shane, for that. We do have a few questions in, but I'm just mindful of time, and we are actually just gone over. So I'm just going to take a few questions, and then the other ones that we would have been sent in, we will try to answer offline, or indeed, as you said, people are welcome to get in touch with you. So just in relation to questions for pension, somebody is asking, is 25 too early to start a pension?
No, it's never too early to start a pension. Because the figures that I showed on the table there, I started at age 30. If you can start a pension at age 25, what it means is that the euros that you put into the pension now are going to be the ones that are going to be invested for the longest period of time, and therefore they're the ones that are going to grow most. So, even a small amount of money at age 25, or as much as you can afford, definitely start a pension if you can afford it.
Thank you. And for public service employees, what are the pros and cons of AVCs versus private pensions?
Well, to some extent, I touched on that. AVCs are a good idea. They will enhance your pension funding. But if you are a member of a public sector pension scheme, in fact, then you don't have the option of having a private pension running alongside it, unless you have another income. For example, if you're a teacher and you're also a farmer, you could have your public sector pension scheme through teaching, and because you have separate income through farming, you could have a private pension through there. But if you don't have a second income, your only option to enhance your pension funding is through AVCs. And then that comes back to the argument of saying, well, is there somebody, if you're married or in your partnership, then, does it make more sense for you to do the pension funding, or does it make more sense for your partner to do it?
Thank you.
So that's as much as I really can say on that without knowing more details. And again, if somebody wants to ring and have a chat about that, by all means do so.
Brilliant, thank you. Well, we are gone 10 minutes over, so I think it is sensible to wrap up at this point. Shane and David, thank you so much for your expertise this evening, for giving us your time. I think that's all really valuable information for people to have, and it's great that we have this session also recorded and people can watch back at a later point if they wish. To clarify anything, and indeed that you've provided your details, and if people do wish to ask you a question in relation to it. Thank you, David. Thank you, Shane. And thank you, everybody, for joining us.
Very welcome.
Thanks, April.
Thank you.